Good morning, everyone. Welcome to the Teachers Retirement System of the City of New York Investment Meeting for April 9th, 2018. Welcome back from vacation, those of us who have been on vacation. And anyway, we will proceed. Patricia, please call the roll.
John Adler.
I am here.
Thomas Brown.
Here.
David Kazansky.
Present.
Deborah Penny. Here. Raymond Orlando. Susanna Vickers.
Here.
We do have a quorum.
Excellent. Okay, with that, we'll turn it over to Rokatan to go through our performance reporting.
Great. Good morning, everyone. So we'll begin with the performance of the passport funds through February 28, 2018. Everyone should have that report in front of them. At the end of February, the Diversified Equity Fund had assets of $15.8 billion. During the month, you'll recall volatility returned to equity markets, particularly in the U.S. and in markets abroad, and as well as markets abroad, rather. And the fund as a whole was down about 3.8%. That's slightly behind the broad U.S. equity market, which was down about 3.7%. That brought the year-to-date return for the fund to positive 1%. And the broad U.S. equity market during that time period, at the end of February, remained up about 1.4%. Really what was driving performance in February was, you'll recall, the volatility, which not only impacted the U.S., but also non-U.S. developed and emerging markets. The international equity composite as a whole was down about 4.4%, and that was roughly in line with the broad international composite index that you use, which again includes developed and emerging markets. Developed markets were down a little bit more than emerging markets. Emerging markets were down about 4%, and developed markets were down about 4.5%. Year to date, I mentioned the fund was up about 1%, and in non-U.S. land, in developed and emerging, those markets are only up about 0.5% during that time period. We've seen further volatility through March, and we'll talk a little bit more further about that. But at the end of February, the fund stood still up about 1% year to date. The balanced fund, you'll recall, which went live beginning January 1st, had assets of about $387 million. In the month of February, that fund was down about 1.5%, and year to date, a modest negative return of about negative 30 basis points. The International Equity Fund I mentioned earlier, doing a little underperforming the U.S. That fund was down about 4.4%. The Inflation Protection Fund in the month of February down about 1.7%. Year to date, that fund was down about 1.5%. The Socially Responsive Equity Fund, about $192 million in assets. That fund was down about 3% in February, protecting a little bit on the downside. Year to date, that fund through February was up about 2.3% for about a 50 basis point relative outperformance versus the S&P. Were there any questions on performance through February? Maybe I'll comment then a little briefly on March performance. So I mentioned continued volatility, which everyone's aware of, given the headlines it's been grabbing. The U.S. equity market was down about 2% in the month of March, bringing the calendar year-to-date return down to negative 60 basis points. In non-U.S. developed markets, particularly in large cap, those markets were down about negative 1.7%. The emerging equity markets were down about 1.1%, so a little bit of relative outperformance by emerging markets, but all in all, negative markets across the board. The underlying strategy for the Inflation Protection Fund during March added about 80 basis points. The calendar year to date return through the first quarter was still negative to the tune of about 80 basis points. And the underlying strategy for the Socially Responsive Equity Fund continuing to protect so far this year, down about 1.7% versus the S&P, which was down about 2.5%. Actually, that fund is ahead year to date, both in relative and absolute terms, so a bit of an outlier in that regard. Were there any questions on February or March? We had another topic for the public session as it pertains to emerging market country screens, something that the board had asked Rokatan to spend some time thinking about and revisiting the approach that this board has taken in the past, and I'll turn it over to Robin to walk everyone through that.
Thank you. So there is a deck that was sent out in advance and also just handed out to you called the emerging market country screening process. So the impetus for this discussion is the fact that the country screening process currently used in the Teachers Fund for public market investments in emerging market equities, it was put into place in 2010. And so the board appropriately felt that this was an appropriate time to look back at the process that was used at that point in time and to review it for continued appropriateness. And so that's what this discussion is focused on. This is not intended to be a complete discussion of this process, but rather an introduction to remind everyone what we do today and how we might do things differently if the board feels comfortable, or what alternatives we might consider. So if we turn to page 3 in this deck, I want to highlight a number of comments that are made here. So the model, and we have a screenshot of that on page, I think it's on page 18, it's exhibit 1, page 18, is a pretty elaborate model that was, as I already said, established in 2010, and the objective of that model was to be very thoughtful and to take into account a number of criteria that the board felt were important in evaluating the appropriateness of individual emerging market countries for investment in the teachers' portfolios. And so it was a very elaborate process by which various criteria were considered, some of which were not retained in the final version of the model. There were weights applied, and there was a lot of work that was done in order to come up with the process that resulted in the screening out from all public emerging market portfolios of Chinese equities, Russian equities, and Pakistani equities. Although it was a very thoughtful and rigorous process, there are a couple of issues that we highlight on page 3, including the fact that the individual rankings, so the weights associated with criteria, are by definition somewhat subjective. They were, again, not randomly assigned, and it was a pretty thorough discussion of how important each criteria was, but by definition it's somewhat subjective. The process doesn't include, although there's certainly part of the discussion, it doesn't include an explicit discussion of the opportunity cost of excluding entire markets. And finally, the current approach doesn't really identify how and when the analysis would be revisited, and we're doing that today. And we note at the bottom of page 3 that probably the most important consideration is that the country evaluation process that we use today is oriented towards eliminating an entire market rather than considering engagement with individual companies. And that's something that the board has discussed in a fairly significant way. And so we want to take a look at this process and see whether we might address some of these issues that we've identified on page 3. So if we just take a look back, take a step back and look at the emerging markets on page 4. What we see on page 4 is a snapshot, and this snapshot is as of the middle of last year, but it hasn't changed significantly. And we just thought it was sort of an interesting way to portray the global equity markets. On the left-hand side of the page, you see a grid, and in this grid, each box represents about $100 billion in equity market capitalization. So you can see that China on this box represents, may not be obvious, but represents the single largest, second largest equity market after the United States. And in aggregate, the Chinese equity market is about the same size as the entire Eurozone. So it is a very significant equity market, and currently we do not invest in it. And that fact is further described on page 5. And what we've looked at on page 4 is sort of the current state of market capitalization. In page 5, what we do is compare the state of affairs at the end of 2010, when this process was first put in place, and we compare it to the end of year-end 2017. And what you can see, if we look on the right-hand side of the table, is that China has, in fact, become one of the world's largest economies and continues to grow as a portion of the global equity markets. And what you can see on page 5 is the U.S. has grown more significantly than any other market. It's grown at year-end 2010, it was 43% of global equity markets. At the end of 17, it's 52%. So a very significant growth. Not the.
I was going to say, just on an
Go ahead.
absolute, at an absolute level, it's doubled in size.
U.S. equity.
U.S. equity.
Right. You can see, because the U.S. equity market has grown so significantly, non-U.S. developed has actually shrunk as a percentage of global equity markets, gone from 43 to 36%. And China, you see the A shares have grown from 2% to 3%.
Can I just ask a quick question about that?
Yeah.
So, obviously, we have a home country bias in our allocation to global equity markets. But in terms of the overall, market, like our allocation, how has that changed between U.S. and developed and emerging markets over that last 7 years? Do you know
In terms of.
In other words, what allocation of our equity, what percentage of our equity allocation has that changed between U.S. developed and emerging markets over this period of time where?
Yes, it's grown. I think non-U.S. has definitely grown. And actually, Mike's going to pull up the numbers right now, but I don't think you have a particularly significant home country bias right now.
Yeah, it's come down over time. I want to say at the end of January, total equity, public equities were about $40 billion, of which $23 billion was in the U.S. So that bias has come down over time.
And you really don't have much of a home country bias, and that was a very deliberate decision over the past several years through various asset allocation exercises to reduce that home country bias.
Okay, thanks.
If we look into the emerging markets more specifically, so emerging markets are still a small percentage of the global equity opportunity set. And it's actually a little smaller today than it was in 2010, at the end of 2010, really because of the significant growth of the U.S. equity market. So on a relative basis, they're about 11% of global equity markets. But if you look at the makeup of those emerging markets, you can see at end of 2010, China was 17%, and today it's 28%. And we exclude in our public equity portfolios 28% of the world's emerging markets.
But can I just? I'm sorry.
Yes.
That's 8 shares, or that's
Yes.
But 8 shares are the ones that are listed in Hong Kong.
Right.
That's correct.
So it doesn't include A shares.
Not today, but they will be gradually adding A shares over time in the MSCI
In the index.
Yeah.
They're not in the index yet.
But we don't, so we don't invest in H shares, even though that, I thought we didn't invest in, I guess because Hong Kong is now considered part of China. Okay, got it, thank you.
Okay. So the point that John was referring to is A shares are going to be gradually added to the benchmark. And so this, assuming that Chinese growth doesn't slow, the percentage of emerging markets that are comprised of Chinese equities is very likely to continue growing.
Thank you.
So just spent some time looking at the growth of the Chinese equity market as a percentage of emerging markets since 2010. There have been other changes as well that I think are relevant to our discussion about this process, and we list some of them on page 6. So there has been a significant effort to improve the transparency of reporting, financial reporting by companies in the emerging markets, and progress has been made. There is still a lot of progress to be made, and one of the recommendations we're going to make at the end of this is that we have some experts come in and talk to the board about these kinds of issues, because this was a concern in 2010. If our managers can't get accurate and transparent reporting, then we have reservations about allowing them to invest in those companies. But if the reporting has improved, which we think it has, I think that's an important factor for the board to consider in as it thinks about this process. We noted before the relative weights of countries within the emerging markets has changed meaningfully. Globalization has further eroded the boundaries between what is an emerging market company and what is a developed market company. Companies source and sell on a global basis, particularly larger companies. And so drawing a bright line between emerging market companies and developed market companies is increasingly difficult. And then finally, we note here that Rokitan and many other asset managers and consultants look at emerging market return opportunities as being fairly significantly greater than that of developed market equities. Developed market equities certainly since 2010 have outperformed emerging markets. And you think on a relative valuation basis, this is not a tactical recommendation, but it is supported by the fact that our return expectations for emerging market countries in general are higher than for developed market equities. And so that, I think, is supportive of this recommendation that we look at a process which serves to focus on companies that should be excluded potentially rather than countries. So on page 7, we start talking about a potential alternative approach. Most importantly, we note on page 7 that any alternative approach which might be considered and potentially adopted should continue to be aligned with the board's principles and values. So this is an exercise in fiduciary responsibility, and the original process was a fiduciary exercise to make sure that issues and risks that troubled the board about certain emerging markets were reflected in the guidelines for our emerging market managers. We are not recommending any change in that posture. Any change to this process would have to still take into account issues, priorities, concerns of the board, and would be reflected in guidelines given to emerging market managers. However, we think that we could do so even with a modified process, and we highlight in the middle of page 7 one approach which might be used in place of the current country screenings. So first, we say that might start with an emerging market statement of beliefs, concerns, and priorities, so that any new process would be clearly shaped by the board's investment beliefs regarding emerging markets. That we would communicate this statement to all of your emerging market managers, and importantly, we would use a third-party advisor to evaluate portfolio holdings periodically to confirm that the portfolios that are held are generally consistent with these statements and with these guidelines, and would identify any outliers for engagement or possible divestment. So again, it's a matter, the process that we have in place applies the board's priorities, concerns, and your view of risks in one way. We're suggesting that these priorities and concerns might be applied in a different way, which might allow for a more extensive use of the opportunity set offered in emerging markets. We note here the potential benefits of this change, which again include increasing the opportunity set and also creating opportunities to foster change through engagement with emerging market companies. The BAM has been very successful in its engagement with developed market companies, and we think that this process might be able to be extended to particularly large emerging market companies. We know here that there are issues that should be considered, potential issues. One is that this embarrassment factor. So this would increase the opportunity set, but also increase the number of companies that you might hold, and we want to be cognizant of this issue of potential embarrassment. And it also is a policy that would require greater oversight by the board, by staff, and by outside advisors. We've dealt with the issue of Chinese companies by simply not owning them. If we broaden the opportunity set for your active managers, we have to take steps to make sure that we're monitoring those portfolios and establishing appropriate guidelines. So what we are suggesting is that we bring in some subject matter experts to meet with the board to provide some information so that you can evaluate whether you think this alternative approach is pragmatic and implementable. And we'd like them to talk about things like improved reporting and transparency from emerging market companies, talk about how engagement might actually be carried out, and potentially bringing in one or two of your existing active managers to talk about their process and how your priorities might be incorporated into their process if you were allowed them to expand the opportunity set to include China. So I'm going to stop now and see if you have questions, comments.
I'll just say, Robin, I like your last bullet, sort of reminding us to also discuss private market investments, because we have a different policy governing private markets. And since we're going through this process, I would definitely support looking at this through the lens of private as well as public.
Other comments or questions? Rob? I'll weigh in a little bit. I think this is a great idea, and I think the process you lay out is very good. A couple of things. So I think folks know that NYSERS also has an emerging markets policy. Suzanne and I sit on that board, control mayor sit on that board as well. And just a couple of things about this. One is that the screenshot from 2010 it looks quite different today because NYSERS has continually updated the model that they use for scoring. And so, in fact, the issue of capital market openness, as Robin alluded to, has really improved all over the world. So that has been eliminated as a separate criteria. And there's some other changes as well. And it evolves. The scoring doesn't stay static. Every year, in fact, NYSERS did a recent, I think 2 years ago, RFP for its emerging markets consultant. And in fact, they used the same their general consultant, Callan, but it was a separate RFP, and Callan uses Verite, the firm that Robin referred to provide data, especially on the labor scoring. And then they use other sources of data for scoring the other markets.
So they use MSCI and
They
sustainability.
use MSCI, they use Freedom House for some of the political stuff. I can't remember, I don't know if you guys remember other sources
Yeah, I
of
mean,
data.
I did want to bring up, we did have a discussion about the applicability and the freshness of the data, which is also something that, we should all bear in mind. Yes, they have these models that have different data sources, but some of our discussion at the other board sort of centered around dynamic and changing situations, political situations and other situations in certain countries, and whether or not the data feeds that are being used to do this analysis, really how timely they are, and that's something to consider because there's a lot of lag time built into this. So thinking about what our goal might be, to capture an accurate picture of the current situation in certain countries, is this data the best we can get, or is it as applicable as we might think it is?
Well, and I think the key point here that Robin is making is that this is a country-based screen, and I think what Robin is saying is that we want to consider evolving to a company-based screen, because there can be countries where there are certain companies that might be deemed worthy of investment. So in Russia, China, and Pakistan, which are the three excluded countries at this point, there might be companies there that we actually think are doing a good job. And contrary-wise, there might be. So here's the interesting thing about China in particular, which is that the definition here is what exchange the shares are traded on, right? Whereas, we know plenty of US-based companies that really have a tremendous amount of exposure to China. Apple, Nike, a bunch of these countries that are sort of, very large market cap companies that are traded in the US actually have a huge amount of their operations in China, and don't necessarily, if we're concerned about reputational risk and labor rights in particular, we've all heard about Foxconn in China, where it wasn't a paradigm of labor rights, and they were manufacturing items for Apple and other U.S.-based companies. So it's complex, and I like the idea of sort of delving into that. I'm not sure that we're going to get to a place where we're going to feel comfortable with it, but I absolutely think we should engage in the process and see where we can land. Personally, I think it's a really good idea. Anybody else have comments? I'd be interested. Mel was here. I think Mel was the only person in the room. Only person who was a trustee.
I was not a trustee, but I actually worked on this from the BAM side.
Okay, but Mel, any perspective on this from someone who was there at the inception of this policy?
I think that it's great to re-examine the position that we had before. There's something that would benefit retirement system, so you don't have to be wed by what we did in the past.
Right. The other thing I would just throw out there is that if we did decide to use a third-party advisor, it might be something that we might want to consider doing with one of the other boards for economies of scale for no other reason. That we spend quite a bit of money at NICERS on Verite and on Callan to do this service, and it might be something worth exploring if we get there. Just something to keep in mind.
Okay, so we will take the first step of the next steps identified here and bring in some folks who we think can shed light on some of these important areas.
Great.
Thank you.
Thank you so much for doing this. This is going to be very helpful moving forward.
Okay. Okay, so I think that is the conclusion of our public agenda for today. We do have an executive session scheduled, so can we have a motion to exit the public session and enter executive session?
I move pursuant to Public Officers Law, Section 105, to go into executive session for discussions on specific investment matters.
Thank you. Deb, is there a second?
Second.
Thank you, Susanna. Any discussion? All in favor of the motion, please say aye.
Aye.
Opposed, please say nay. Any abstentions? Motion carries. Okay, we're back in public session. Susan, would you please report out of executive session?
In executive session, a presentation from a service provider was received and discussed. A manager update was presented. A quarterly report on a partnership was presented. The results of an RFP for an investment strategy was received and discussed. Consensus was reached on adding managers to a pool for potential use. The managers are listed on page 24, page 135 in BAM's memo. A presentation on a private equity investment was received and discussed. Consensus was reached.
Okay, thank you very much. Anything further for public session? So a motion to adjourn would be in order.
So we give that one to them.
Okay. Is there a second?
Second.
Thank you. Any discussion? All in favor of the motion to adjourn, please say aye.
Aye.
All opposed, please say nay. Any abstentions? Motion carries. We are adjourned. Thank you.
Good old